Exactly why do I have 11 different positions in Tesla? We'll go through the reasoning behind this and much more in this video. Stay tuned. Welcome back, mindful investors. If you're new to this channel, welcome. In my speculative portfolio, I have many different positions, as you can see here. We have possibly 50 plus actions a month. This certainly isn't as passive as my dividends, all-weather, or growth stock portfolios. I won't go through every one of my holdings here, but I can generalize them into 5 different strategies. I'll have timestamps in the descriptions below if you want to skip along. Number 1. Things aren't as bad as it seems play. So as we know, the stock market is very volatile. When it goes up, it can slowly trend upwards like this for many years possibly. But when it goes down, it drops like a rock. As we can see in March here, it dropped 35% within a 3-week time frame. And prior to that, it could have taken 2 years to accumulate the 35%. This type of scenario happens over and over again, not just with the stock market index as a whole, but with individual stocks. In the stock market, there are over 5,000 different companies, and every single week, there's gotta be dozens of companies that swings by 10-20%. And this is where I come in for strategy number 1. For example, in early September, Tesla went from 500 all the way down to 330 in about 2 weeks time. And that's a drop of 30% over 2 weeks. The bad news that triggered it was that they couldn't enter the S&P 500 index yet. As I recall, this whole rumor of entering the S&P 500 started in July when the stock price was at $280 and Tesla rocketed to $500 within like a 6-week time frame. So while I was tanking from 500 to 330, that's when I made the move. I started selling put options on Tesla, which means I'm establishing a floor on the stock price. So when the stock price tanked like this, I'm saying that it wouldn't break this floor here. As you can see here in the photo, I sold so many different contracts at various prices. I sold them at $280 because this news isn't permanent. It doesn't mean that they won't enter within the next year. It's just temporary. And all of this started early July when the stock was at $280. So I'm saying it wouldn't break $280 and continue in this projectile. I sold many more as insurance. I have $180, $160, $140, $200, all the way across. I think I started making these moves when the stock price tanked 20% to $400. As you can see here, every single one of these are in the money because the stock price slowly climbed back to 400 and it hovered there for a couple weeks. And that's what I wanted. Drop the video a like if you own any Tesla shares. After collecting all these premiums, we have number 2, the long shot. While I'm collecting all these premiums, I want to take the long shot that 2 years away, Tesla could be a $1,000 company. So my strategy 1 and 2 kind of goes hand in hand. First, I collect all these premiums. Second, I go for the home run play. And the analogy I have here is for boxing. No professional boxer would just go in and just keep swinging away. Like 100% power, just swing. And you waste all your energy. For my number 1 and 2 strategies, I have a lot of jabs. So my selling put options was my jabs to collect the premiums. So I just keep jabbing away. Keep jab. When I feel the rhythm of the fight, that's when you do the right hook. When you feel comfortable out there, that's when you do the right hook. My long call Tesla 1000 2 years away. All of this makes sense to me because ultimately, it's almost like a free play for me. All these jabs I'm making is subsidizing for my right hook. We can see here that from all these short puts, we probably accumulated like $4,000, let's say. And then my Tesla long call was at $7,000. So I'm making this play at a huge discount. Number 3, calling bullshit play. I've implemented this strategy many times this year. 2 examples were Nikola and Shaw, or Hyliion we call it. When I looked into the background of the company and the CEOs, I knew it was all bullshit. So I sold some call options. What this means is that I've established a ceiling, that the stock price will never break this ceiling here. For Nikola, I set it at 130 and it never got past 100. So this $1,000 is for my taking. Right now it shows a gain of $978. Same for Hyliion. I put a ceiling at $70 and it only got up to about $50, $55. before it tanked down to like 25 right now. For this one, this $1,000 plus is also in my pocket already. Another example happened this week. Gamestop on Thursday spiked like 35% in one day. With this news, partnership with Microsoft. As a mindful investor, I have to click in and see what the article is about. How can a gaming retailer partner with Microsoft and what kind of upside can they get? I read the article and they said that they're changing the back-end system and the point of sales to Microsoft Surface. So pretty much they're just changing the back-end software and hardware. How does that drive sales? How does that justify any of this 35% gain? And that's when I sold more call options. Today, early morning, it jumped another 10% and I sold even more. A lot of times we see these jumping gaps in stock prices. What this means is just a short squeeze. We can go through that in the next video. But it happens over and over again. Whenever a stock price jumps like 20% in a day, the next day it can possibly jump another 10 for no particular reason. And the days after, or the hours after in my instance, it'll just drop right back down. In my GameStop instance, it peaked at around $14.50 early this morning, but it closed the day at $11.75. So from the peak to the close is a 20% drop. Right now it's about 50% in the money. So how do I capture the rest of it? As long as the stock price stays flat or slowly goes up or down, it doesn't matter. If it doesn't break my $30 ceiling, I'm fine. And I'll let time do his work. Number 4, cashing in the Hypetrain win-win play. For example, we'll look at Fiverr. I bought the stock a couple months ago at 116. Right now it's at 162. It jumped 5% today and maybe 20% for the past week. What I did here is I sold a call option, also called a covered call play, which means I have the 100 shares of a certain stock and I sold a contract of it, meaning I'm willing to sell it at 240. I'm willing to sell it at 240 November 20th. So over the next month, if it goes up another 40% and it breaks my 240 price, I'm happy to sell it and capitalize on my gains. But if it doesn't continue in this trajectory and go up and break this 240, I collect the premiums. It's not too much money, it's about 250. But if it doesn't break, I collect free money. So this is why I call it win-win play. It doesn't matter which way it goes, I win. Number 5 is playing the news play. I bought 100 shares of Apple a couple weeks ago at 109. Right now it's at 118. It went up 2.64% today. And what's interesting about Apple is that they have an event. They have the iPhone event on Tuesday, October 13th. And since iPhone is the main driver for the revenue, Tuesday is a critical date. As we get closer and closer to that date, a lot of people are willing to bet on Apple, saying the stock price will just jump up or jump down 10%. What my plan is before the event, I'll sell another call option because that's when the volatility is the highest, so the premiums are the highest. I already sold a call option on Apple. For December 18th, I sold it for $150. So what I'm saying is that the stock price won't jump 20% over the next 2 months. And if it does, then I'll sell my $109 shares at $150. Why not? Right now, I'm going to go through the whole 11 Tesla positions and just explain my play within the play within the play. So the first one, Tesla shares, I have 35 of them. These are for my long-term holdings. And then these next two at -5 and +5 contracts ending December 18th, 2020 for $600 call is where I sold the calls, and $620 is where I wrote the calls for 5 contracts. So what this means is that I put a ceiling for Tesla at $600. I'm saying it won't break 600 by the end of this year. The second position here acts as an insurance, saying if it does break 600, then what happens? If I don't have this in place, then my losses can be unlimited. It can jump to $10,000 and I have to fork out maybe $1 million out. But since I wrote this contract, I have insurance on it. And the maximum I can lose per set of contracts here is 620 minus 600 times 100. So 20 times 100 is $2,000. That's the maximum I can lose per one set of contracts. And the gains for it isn't very much. It's about like $300 per set of contracts. So if we use a betting analogy, I'm laying 3-to-1 odds that the Tesla stock price won't break 600 by December. And someone on the other side of the table is willing to take that bet. So if he wins that bet, he wins 3-to-1. So he's putting $300 out to win my $1,000. We talked about the long shot $1,000 Tesla 2 years out. This is also called a leap. So any option you buy that expires more than a year away is called a leap. Mine is 2 leaps. And then the next 7 contracts is just my short puts. And all of them are in the money, as I mentioned before. So in conclusion, with all these options play that I have, I'm just making things much more complex than it needs to be. If you like a simpler approach, check out the other 3 videos. The dividends, all weather, and growth. All of them you just buy monthly and you forget about it. This one is for active investors like myself. I like to spot opportunities, I like to capitalize on it, I go crazy. It's not recommended for everybody. So what do you think about my 5 different strategies? As a recap, number 1, things aren't as bad as it seems play. Number 2, the long shot. Number 3, calling bullshit play. Number 4, cashing in on the hype train play. And number 5, playing the news play. Which one of these strategies would you want to try out? Let me know in the comment section down below. As always, thanks for watching. Remember to hit the like and subscribe button if you found any value. Take care and I'll see you in the next one.